Hello everyone. Welcome back to the YouTube channel of Spark Hansraj. Today, we'll continue with our budget series. From changes in income tax slabs and capex bazooka to affordable housing boost, Budget 2023 has something for everyone. And here we are to address one of the most crucial queries, which is to explain the new tax system and how it will affect the people of our nation on the average.
We have with us Mr. Sridhar Ramachandran. He is a qualified company secretary and a lawyer with over 22 years of work experience. For more than 15 years, he has been a part of PwC as a corporate advisor. Currently, he is working at Grant Thornton, guiding companies with distinct knowledge and experience in the field of corporate law. And he comes with us today to explain the new tax system and how it will affect the people of our nation on the average. Thank you for joining in, sir.
Thank you, Yugam. Thank you, Sahil, for calling me over. It's always a pleasure to address uh, a young gathering. Good morning, everyone. Today's subject matter is, of course, been kind of discussed threadbare across forums, and there's been a lot of water that has flown over the last couple of days around how the finance minister has taken on the budget. It's probably her last budget, full budget before the elections get done, and therefore there was an undercurrent that there could be some populist measures. Interestingly, fiscal prudence and discipline has kept us away from rolling out freebies, and there's a very clear message coming through that we are in a world which looks at fiscal discipline and prudence in a much more detailed way as compared to giving out or rolling out things that look good in the beginning or look good initially, but then have impact in the overall economy and development. So we are seeing those situations play out in our neighboring countries, and therefore it's important that we set the right context. And I must congratulate the government and this regime to have made sure that we are on the right path. In fact, beyond that, we are also on the right path to use what we earn as taxes or as borrowings when we borrow from the market as a government to put that to use for capex. So that's really a significant shift that we have been seeing over the last few years, and this budget takes it to the next level. Now, as you know, the economic growth in the current year is estimated to be about 7%. And this budget actually has put out a vision that it will have all the steps taken for an empowered and inclusive economy, which is technology driven, knowledge based, and has strong public finances and a robust financial system. So, despite what is playing out in the capital market qua the Adani Group controversy, we are seeing that the financial market in itself is fairly robust, and that's a fantastic signal for us to give out as a country that we are significantly strong in across businesses and across entities, and one significant contributor to the indices does not necessarily mean uh, that it will have an impact on the country's economy or the capital markets or the financial segment. Now, coming to the focus, the thread has been infrastructure and investments and green growth. And therefore, if you see a capex growth of about 33% has been kind of incremented into the overall budget, which means that you have a 10 lakh crore capital outlay that's going to play out in this period. And railways in itself has a capex outlay of 2.4 lakh crores, which is about 9 times of what the outlay was in 14-15. So if you see significant move to from the government to put money into relevant things, which will result in long-term benefit coming through for the economy on an overall basis. And this is what is expected from the taxpayers' money as well. So that's a significant plus. Now, if you come to specifics, and most of you will be interested to know that there is, as you know, 5G has been rolled out, and there's a very clear direction that there will be 100 labs that will be set up across institutions and colleges, which will help in raising new business models and last mile connectivity across the country. So it means for some of you or most of you, opportunities across technologies to improve delivery of government services as well as improve business models in themselves. The next level of conversation is also the open source digital public infrastructure, which will be created to encourage agri startups. And again, this will combine with just these 100 labs. These two, according to me, are pointers for things that you should watch out for as the youth and the next level of generation that takes up businesses, etc. Now, let me come to tax, and that's my strength. And I'll spend the next 10 minutes in explaining some of the interesting tax provisions. As you know, tax is a matter of fine print. And if you get your full stop and comma wrong, you interpret things very differently. Because of that, there are a few things that may have missed in the finance minister's speech, but certainly have gone into the language, into the amendment of the Finance Act. So let me start with the overall position that for corporates, partnerships, and LLPs, the income tax rate, including the surcharge and health and education cess, have not changed. So no change is good. It gives you a consistency across period, and therefore for corporates, it's a very good thing to say that we are not tinkering with tax rates any longer, and therefore this includes MAT and AMT rates as well. So which means government has moved very well in that direction. For the startup ecosystem, there are two tax proposals which I'd like you to kind of remember. One is the proposal to extend the last date of the tax holiday benefit, which was earlier 31st March 2023. Now it has moved to 31st March 2024. Now we would have expected a bit more stability in that proposal. But what we have seen in the past has also been that government has been wary to give a benefit which has no sunset, and therefore to that extent we have seen this uh, holiday creeping up over the years, every year since the last few years. Now, what does it mean? The tax holiday in itself is a holiday of 100% exemption of the income of that startup, which uh, can be claimed for 3 years in a block of 10 years. That's really the benefit that you can expect. And this block of 10 years starts from the date of incorporation of the company, the startup company or the entity. And this has now gone up to the next year. So if you formed a company or an LLP within 31st March 2024, you have the ability to claim this 10-year exemption, 10-year block, a 3-year exemption over the next 10-year block. That's the first benefit that has been passed on. The next benefit is the provision of carry forward of losses on account of change of shareholding of the startups. Now, there is a section 79 for people who are interested to know the sections. there is a section 79 which had an overarching provision that losses of a company cannot be carried forward if the shareholding pattern of that company changes from more than 51% from the year in which the loss was incurred as compared to what it is when the loss is to be claimed to be set off. So if the change of shareholding happens beyond 51%, losses are you can't carry them forward; they are lost. So what government did in 2020 was to say that in the case of a startup, even if there is a change of shareholding beyond 51%, as long as the founders and the shareholders who were originally owning those shares when the losses were incurred continue as is, uh, uh, that situation, the losses were allowed to be carried forward, and this was a test for a period of 7 years. So for 7 years, government said you could stretch this logic for startups to claim the benefit under 79. Now that 7 has become 10. So if you see the logic of what has been done, you will see that it links up to the 10-year block of the holiday that we spoke of earlier from the date of incorporation. So this loss is also from the date of incorporation. That is one. And two, it also links up to the fact that any investor coming into a startup does not upset the holiday as long as the original founder and the promoter groups continue to remain invested in the company. Now, there's been always a heartburn that it means that for a period of 10 years, the original investors can't even sell one of their shares. So they will have to earn out of this through salaries, etc. So a share capital divestment from the promoter group is not possible. So it is a pain to even fulfill this condition in the first place, because for 10 years, if you don't expect your shares as a promoter to be, it's almost like a lock-in if you want to hold your losses. So government is indirectly saying that in 10 years, if you have not used your losses, then we have a foundational problem on what that startup is doing. It should have earned sufficient profits in the first place anyway. So there's some economic guidance on what you should do as startups, not shore up losses, but quickly get into profit so that this problem doesn't remain a problem. So that's the bigger picture, the way you see it. The other element that you must also note is that Section 72 itself has not changed. So there's a slight disconnect here that 72 itself only limits carry forward of losses up to a period of 8 years. So if you have an 8-year limit on an overall basis, stretching this to 10 years is theoretically a disconnect. So you can't, in this section 79, stretch a loss to 10 years when the original section of even a normal carry forward of losses where you don't change any shareholding, that in itself is limited to 8 years. So there is a disconnect here, and we are hoping that in the fine print, the finance ministry will take care of it. But though that would be the interesting change for startups. Again, for startups, there's one caution that has also come up, and actually, it's not for startups but for pretty much everyone, which is the ambit of section 56 to 7b, which is in common parlance known as angel tax. Now, what was angel tax? Essentially, it meant that if a company in India got premium which it could not justify uh, beyond a point, that premium was subjected to tax as if it was other income of that company. So it's a capital receipt which is getting taxed as other income in principle. which is fairly worrying for companies overall. Now, there was an exclusion for startups which continues, but a lot of startups don't know that they have to specifically claim this exemption through a specific application to the CBDT for this purpose, and there's an interministerial board which actually approves this. So not just the DPIIT approval, but also an additional approval specifically for 656 to 7B has to be included. The earlier, so now the change. What is the change? The change is that earlier the ambit of section 56 to 7B was limited to monies that were gathered from investors who are residents. Now, this has been increased from ambit coverage to include non-residents as well. So, which means even a foreign investor is subjected to the test of making sure that he doesn't pay more than the premium that the company can justify. So, it's a double-edged sword because there is also a section on the other side which says the shareholder should not benefit, and that's of course a qua transfer of shares, but this is a bit of a sitting on the sword's edge, because a valuation will then decide what is the fair assessment, and valuation in itself for startups has always been a challenge on the basis of what they should be looking at. But this is an important element to be covered. So several private equity investments and strategic investments in across the board from foreigners will need to be very cautiously kind of measured in the context of this change. From an M&A perspective, one interesting change, and this is coming through from some case law which has already been set through by the courts in India, is that any intangible asset that is self-generated, it was not very clear what is the cost of acquisition. So now it's been put out into the section itself to say that the cost of acquisition in relation to an intangible asset or any other right around that asset is taken to be nil for the purposes of computing capital gains. So it's an alignment to the, so we can't take case law to say it's, you can't determine the cost and therefore this is not taxable. A lot of people were taking that position. That's now gone off. Cooperative societies, significant thrust. So you will see there's a new section 115 BAE, which has been introduced to cover cooperative societies which are engaged in manufacturing, which start manufacturing before 31st March 2024. So the cooperative society should have been set up after 1st April 2023, and it should have started manufacturing after before 31st March 2024. If it does these, if it meets these two conditions, it will get a concessional tax rate of 15% for life of the cooperative society. So it's a very big benefit. We already had this for companies which were doing new manufacturing facilities. Effective tax rate from 15 with including the surcharge and cess, etc., comes out to 17.16%. So this is now extended in addition to companies to cooperative societies. So that's a big move, and cooperative societies like we had the classic case of Amul, which has grown out from cooperative societies, Lijjat Papad, and there's so many examples of self-help groups constituting themselves as cooperatives doing well. So this augurs very well for agri producers and for smaller cooperative businesses to work together to get this going. And manufacturing is the thrust. So we could see some very interesting models coming through from self-help groups, etc., in this area. One possible miss is the fact that there was a sunset which was there till 2023 July for availing the reduced tax rate of 5% on interest on foreign currency loans. Now, foreign currency loans basically mean external commercial borrowing under the RBI's understanding. So, if an Indian company was borrowing from a non-resident, there was rules around external commercial borrowings that you have to follow under the Reserve Bank of India guidelines under FEMA, Foreign Exchange Management Act. But there was also a benefit in income tax to only tax the interest payout at a concessional TDS of 5%. That has gone off, or that has not been extended. So there was a sunset to that 5% rate, which is 2023 July, which has not been extended. What it means is if you borrow from a non-resident now, and if you pay interest henceforth, the interest TDS will either be 20%, which is the default rate under domestic law now, or the treaty rate, which could be depending on whichever double tax avoidance agreement treaty is there, to say a 10%. So you will not get the 5% rate. So government seems to be saying that our banking system looks very robust. Why do you need to borrow from overseas, especially when there is so much pressure on the rupee in currency rates as well? So if you see, rupee is kind of also depreciated significantly. So government is saying look for domestic borrowing. So that's the underlying thread that you can kind of see from here. Uh, from corporate perspective, one good thing for small businesses, the presumptive tax threshold for small businesses earlier was 2 crores, has now gone up to 3 crores, which means that uh, you don't need to keep detailed books of accounts and get tax audit done and all of that for businesses up to 3 crores of turnover. And you pay tax on a presumptive basis of 6% or 8%, depending on what you are providing as a business. A similar threshold increase has also been done for professionals. So for people who are in the CA fraternity or lawyers, etc., there's a presumptive tax basis which has been increased from 50 lakhs earlier to 75 lakhs. So you can just merely say that 50% of that 75 lakh is really what you offer to income, and 50% is tax free. So that's a big thing for professionals as well, which is really positive. Now, coming to some of the individual tax proposals, and I'll probably stop in another 5 minutes for Q&A, if that is okay, Sahil, Yogam. Uh, so the first thing is the cap on deductions of capital gains on investments in residential houses. So this was a big thing where they have proposed a limit of 10 crores to cap the capital gains reinvestment provisions if you were to sell something else, and that included a previously owned residential house and or investments. So even if you had sold shares of a startup and had a long term gain to reinvest, you could have theoretically put that money into a residential house and all of it would have been exempt. Now there is a cap of 10 crores. So what it means is also the fact that 10 crores in itself is a fairly large cap for government to extend, and beyond that government is saying let's not let go of this revenue. So it's a leakage plug, revenue leakage plug from the government, which is good. From a personal income tax perspective, again, for HNIs, that is people who are earning more than 5 crores, the overall surcharge has kind of been rationalized to 25%, and effective tax rate therefore has gone down from 42.74 to 39% odd, which is very good, which means a lot of things, and we can kind of look at that in detail. There's, of course, a new personal tax, income tax regime, which is fairly elaborate They have reduced the number of slabs to five. They have kind of given a rebate for income up to 7 lakhs. So people earning up to 7 lakhs effectively are not going to pay any tax. You are not tested for savings, etc. So there's quite a bit there. Slew of changes there. Uh, uh, there's one provision around TCS for overseas remittances, and this is something that uh, has kind of taken the savings so if you are using what is called the liberalized remittance scheme for making outward remittances for investments in listed stock overseas or buying property overseas, etc. There was this RBI has, as you probably most of you may know, that $2.5 lakh per year can be sent out of India by individuals for these purposes, but it is an overall limit. So if you want to gift something to your relative overseas, or if you want to buy a property overseas, or if you want to invest in, say, an Amazon or Google, sorry, Alphabet, or any of these companies listed overseas, you had this ability to do this through this $250,000 limit. It also included remittances for tours. So if you're doing a holiday outside the country, all of this is within that limit. And hospitalization expenses and medical treatment expenses, as well as expenses for studies abroad. So if your kids were going abroad, or if you were using your parents' limits, you had this limit coming in on an overall basis. So now the TCS, now this is a provision which says tax will be collected at source by the bank, the authorized dealer bank who will make the remittance on your behalf. They are expected to collect, earlier they were collecting 5%, now they are expected to collect 20%. That's a big jump. So 20% of what you are remitting overseas will be collected as tax collected on your behalf at source and deposited in credit for your income tax liability as the person making the remittance overall. But it also measures you for each remittance. And while this 20% does not include remittances for studies abroad or for hospitalization expenses, every other expense is covered by this mischief. So if you are traveling abroad, or if you are making investments in equity, listed shares, etc., you should expect a 20% TCS, which is a fairly large number in absolute terms. And every time a remittance is made, this TCS will kick in. Of course, subject to within the overall limit of the RBI of $250,000. So those were some of the key pointers that I wanted to put across to this group. Uh, there are some provisional procedural changes which I think it talks about search and seizures and faceless assessment and penalty related, but most of them are to ease doing business and decriminalize tax provisions while being balanced on revenue collection. So broadly, that's been the directional change. And there's also a talk of kind of making the income tax return form a bit more straight and easier to fill. And we are trying to see how that will fit into the new regime. But broadly, slew of changes which at the macro level promote the overall economic growth, provide relief to individual taxpayers, I must say, and reduce compliance stress as well.
So the first question is, Will removing deductions affect this habit of savings of the common man?
Yugam, government has done quite a lot of economic modeling to kind of play out the new tax regime. So if you see how it works now is that there's no restriction on somebody to freely save on any kind of instrument. So you are not limited to save for insurance products or do some special savings or special infrastructure bonds, etc. And or you're not forced to take a housing loan or do a planning around your housing or, or your house rent allowance, etc. So because it's a flat tax regime, up to 7 lakhs, there's no tax for any individual earning up to that much. And how that has played out is that there is a rebate which the government has given. So while the tax slabs say that beyond 3 lakhs and up to 6 lakhs, you will pay a tax of 5%. And from 6 to 9, you will be at a 10% rate. But what it means is if you still are earning up to 7 lakhs, there is no tax because government is giving back the tax as a rebate. So for the lower tax bracket, no planning required. It's a flat tax. You don't have to worry about saving instruments, etc. For the higher tax bracket, which is certainly beyond the 20% threshold, which is above 15 lakhs in earnings, there again, because the standard deduction is now available for everyone, that in itself of a standard deduction of 50,000 is available under the new tax regime also. Again, it reduces the effective tax impact even for them, including the fact that the tax slabs themselves have got rationalized. So certainly going to wean away tax uh, as the reason for savings. Indians generally save well, and that's why government is believing that we don't need to force it through an income tax law. It could also mean some of the earlier products that people were already saving in will end up playing out for benefit under the old tax regime. So some computational mathematics will go through. So people who have already got housing loans and or people who have already got investment products that are within the 80C limits, they will have to weigh in to see if there is a advantage to move into the new tax regime. But there's a scope creep that people may have missed in the fine print. Government has now, the income tax law has now clarified that if you have taken the benefit of an interest deduction for a housing loan in your tax returns in the past, you cannot add that to the cost of acquisition when you sell the house. So the capital gains computation has got an adjustment. So you have to be careful that you can't. People used to take double dips earlier in adding the cost of acquisition, the interest also. But now there's an explicit block there. So to answer your question, savings are not driven by tax. Hence, it's going to be a market-based economic decision of the individual that will play out more than what tax authorities decide. So to that extent, I would think it's a brilliant move to free up more investment products for individuals, while tax remains outside the conversation as a planning tool.
Thank you so much, sir. Sir, apart from this, you just told us about the rebate. And sir, apart from this, like, what is the motive behind the reduction of the surcharge to 25%?
Yeah, so see the HNI bracket. was at a very prohibitively high tax rate, and I recall that its effective tax rate, if you are earning more than 5 crores, your effective income tax rate is 42.74, which is prohibitively high. So even a 25% rebate on the surcharge brings this down to 39% in effective tax rate for such HNIs, which also means that that 3% extra cash that that individual is having will go into meaningful investments, because HNIs usually want money to work for them, as compared to people like the common man who is actually working for money. So it's a big shift to give that extra 3% to the individual at the highest tax rate level. So that's really the reason for moving to this surcharge less.
Thank you so much, sir. And this was so enlightening. I mean, the way we got to understand the new tax system is something extraordinary. And also, never thought the way you thought about no change is good. So, thank you so much, sir.